So it is my privilege to now introduce our evening speaker, Jerry Cuddy from Beneficial Bank in Philadelphia. Jerry is a 35-year veteran of the financial services industry and has served as president and CEO of Beneficial Bank since January 2007. Beneficial Bank was founded in 1853 and is the oldest and largest bank headquartered in Philadelphia with $5.8 billion in assets. Under Jerry's leadership, the bank has grown, completing 4 major acquisitions, but he has also reoriented the bank so that it has a strong focus on financial education. He considers the bank an education company and has modeled his branches after community centers with shelves full of financial literacy resources that customers and community groups can reserve for meetings. We've talked earlier today about financial technology and all of its advantages and maybe disadvantages, but certainly, Jerry, what you have done is really put a focus on interactions with customers. I have heard that Jerry even makes house calls with his consumer and commercial customers, so we look forward to hearing about that. And of course, and not unexpectedly, serves on boards including the Foreign Policy Research Institute and the Pennsylvania Academy of Fine Arts. He holds a bachelor's degree from Villanova University and his master's of business administration from St. Joseph's University in Philadelphia. Now, a small connection here, I had a brother, he's now passed away, who was a professor of chemistry at St. Joseph's. His name was George Nelson. I don't know if you ever ran across him, but at least we have that small connection. So one little side note about Jerry, if you happen to take a look at American Banker, there was an article that was an interview of Jerry, and it said something like this. Well, it said exactly like this, actually. By his own admission, Cuddy's speeches are often sobering for his colleagues to hear, particularly in times of economic growth, pristine credit quality, and consistently strong earnings. When I go to conferences, I am always the least optimistic guy, Cuddy said in an interview. People boo me off the stage. Well, please join me in booing Jerry Cuddy.
Okay, nobody's booed yet. Thank you and enjoy your evenings. Good evening, thank you. I really am grateful. I'm really honored to be here. I want to thank the entire team from the St. Louis Fed. This has been an amazing conference for me, and I've really enjoyed it. I read most of the papers over the course of the weekend, but the content and the stories and just the anecdotes, they kind of provide the backdrop for all the research has just been incredibly impressive. So thank you for including me. Ironically, since I was originally asked to speak here, my bank is being sold. So we're being sold, yeah, you can boo, to a competitor from an adjacent market. So my 35-year banking career is coming to an end. I'm going to be an outgoing CEO. And it doesn't really change my perspective or my comments, but it did allow me, when I was putting everything together to think of things over the arc of, kind of 4 decades of banking experience. It also kind of underscored for me the fact that in 6 or 7 months, I won't be working full-time day to day. I'm going to go on the board of this bank, but I'm really not accountable for any of my remarks. You can't hold me to any of my opinions. So I'd like to just spend a minute to tell you about the history of Beneficial Bank. It's similar to lots of other people in the room and the histories of their organizations. It might have 1 or 2 little twists, but it is very much a community bank, and I am not, I have been for the last 12 years, but prior to that, I was not a community banker. I came from much larger banks. So it was founded in 1853 up and down the eastern seaboard. From the late 1840s up until about 1860, there were massive waves of Irish immigrants coming in because of the poverty that was occurring in Ireland. To a smaller extent, the same thing was happening with people from Italy. So in Philadelphia, it was the largest population increase, not in terms of people, but in terms of percentage. The city's population over the course of 6 years increased by about 30%. If the Irish could find a job, it was menial or manual, very hard labor, and if they were paid, it was for cash. For safekeeping purposes, they would keep the cash with their parish priest. So by 1853, the beginning of the year, the Bishop of Philadelphia, the Catholic Bishop of Philadelphia, became very concerned about the amount of cash that was accumulating. So he took the board of a local Catholic hospital, he locked them in a church basement, and said, you're now the board of a bank because savings is a beneficial activity that everybody should engage in. So that's where our name and our history came from. So as was mentioned earlier, 165 years later, we're the oldest and largest bank headquartered in Philadelphia with about just under $6 billion in assets. But it's a tradition and a legacy that we hold on to and we talk about a lot in terms of financial literacy. He walked the docks. We have portraits and illustrations of him walking the docks to meet the immigrants, to try to find them food, to try to find them a place to sleep, and later to try to find them jobs. And in fact, he was elevated. He's a Catholic saint now, St. John Newman, who was canonized in 1977 or 78. So turning back to community banking in the 21st century, I wanted to note at the outset that I don't know I'm going to tell any of you anything that you're not already aware of. I'm just going to try to package things a little bit differently and share a different perspective on where I think community banks are going and where we're all going as community bankers. I've got some ideas on the steps that our organization was taking that I want to share, but a big part of my thesis around all of this is that the answers for all of us for the 21st century, or at least some of them, lie in the 20th and 19th. So I'll dig into that in a second or in a few minutes. But I'm going to examine three specific areas. The first is the operating environment. The second is our industry, just looking at us and examining us. And then third is the future, and I think some action steps that we should all be taking. So along the lines of that article, I'm just going to acknowledge up front, this is my perspective, which is great because if it's my perspective, I can't be wrong and I'm not being held accountable, so this is a great night for me. I believe that we're in a tough industry at a tough time, and I don't think I need to look much further than the operating environment for evidence of that. And I think there's a fact pattern that's formed that we don't often link together, and I think part of that is because it's slightly negative. So everybody here, everybody needs to evaluate all their plans, all their strategic thinking, all their projections on the continued growth and or a manageable cycle in which we all do business. At the same time, watching all of our risk management and all of our risk indicators. But having said that, and as a lead up would suggest, for the next few minutes, I'm going to bring you down. But we're all going to get through it together. You can move seats closer if it gets difficult. And I'll tell you when that part's over and when we're going to move into the happy stuff. So I believe that we have an obligation in all of our jobs to honestly examine the operating environment. And the way I view the operating environment, I start with economic growth, and I think it's good. For me, it's robust. I think part of it might be a little bit disproportionately associated with the tax cuts that haven't burned off yet, but I don't know that it's sustainable. So I do believe that there's going to be a positive cooling down in the cycle and that we're going to have to catch our breath at some point economically. And I travel from there to the stock market and look at the valuations, and I just think things are a little bit overheated, a little bit overvalued, particularly since so much of the market is now dependent on so few names, particularly in the tech industry where there's a concentration. So I don't need to educate anybody here about rates, but I believe that rate increases will likely continue, but a flattening of the yield curve combined with slow loan growth, it's creating even more competition in all of our markets for loans, and it's limiting our ability to pass on those higher rates to our borrowers. I also think the increases in the short-term rates, it's creating pressure on the funding side, at least of my balance sheet and the people that I compete against in Philadelphia and in southern New Jersey. We're starting to see deposit betas and competitive rates move up, which is almost counterintuitive given what's going on with our loan spreads. And that's happening now in the fall of 2018 beyond negotiating with large customers or corporate cash management customers. So I think as an industry, we're not there yet. We're not yet seeing the benefit of the rate cycle or rate increases. Again, I'm sure you're all aware of this, but I do believe that for this era, and I worry for the millennials, the biggest macroeconomic trend in the entire world is the amount of debt. So sovereign debt in the last decade has doubled to $60 trillion. Corporate debt is at $60 trillion. The federal debt, including all unfunded entitlements, is hovering at around $100 trillion. So local state governments, I'm getting the looks now. I'm getting emotional feedback. I'm almost finished this part. But I mean, local municipal, it's $5 trillion. And out of all of that, the thing that I worry about the most is kind of, for me, the big three. So I look at auto, I look at student, and I look at credit card. They're either back to $1 trillion or they've crossed back over from crisis level. So all of that puts strains on cash flows for companies, for governments. It puts pressure on taxing ability in the future. I worry about the overhang of that pre-cycle, and I'll come to that in a few minutes. I, honest to God, believe, given the exam cycle that we've gone through over the course of the last 2 years, regulatory relief is spotty, but attitudes have changed. I think that's been a real positive. But having said that, we're all now in the community banking sector bearing the expense from the big bank adjustments that we had to make. It's all been institutionalized, and there's some things that we would like to let go of that we can't yet, and there's some other things that we've taken the expense, particularly in terms of risk management, that now I'm kind of addicted to, so I'm going to hold on to it. I wrote part of this, before our deal happened, but rapid consolidation continues, and here I am, and next year here I will not be. But I started 35 years ago. 35 years ago, there were 20,000 banks in this country, and now we're down to under 6,000. The top 20 banks now hold 60% in terms of national deposit share. So for me, the concentration, the too big to fail, has just become too big. And it's very, very difficult as a community bank to compete. Over the course of late 2017, 2018, I've watched as the larger banks have invested very, very heavily in their retail banking training and their marketing and what they're doing around incentive plans, all around customer service. So if you look at the indicators, the J.D. Powers and some of the Gallup numbers, for the first time ever in the second quarter of this year, some of the larger banks eclipsed some of us for customer satisfaction and retail delivery. That's unheard of. So we're now going to have to compete against those guys on service, which was never the case before. And then there's all the cyber risk challenges, but to the extent that I'm challenging everybody here, I'll pass on that for now since we've covered a lot of that today. You all know about fintech. It seems to me that they're more lightly regulated than we are. They've got, on certain days I talk to people, it seems like they've got access to unlimited capital. They are emerging, and every time I think that they are going away, a new wave of fintech takes its place. Lots of new customer entrants in terms of millennials, which I think is a distinct positive in some respects, but also they are very educated about what they want. We heard from the students and the graduates from Eastern Kentucky University earlier. These are really sophisticated consumers of not just banking services, but service itself, with levels of customer service expectations that we're all now challenged to meet. And as you all know, the customers just aren't moving banks. So that number continues to be between 10 and 12%. Half of that's rate shoppers, a quarter of that's just people that move geographies, and that other 25% is what we're all battling over. So I still think that as this year ends, the most interesting trend that we're all facing is the displacement of our balance sheets. And not to sound overly dramatic, but when you look at when you look at the asset side of our community banking balance sheets, and you look at LendingTree, or you look at Cabbage on the asset side, or you look at Ally or Marcus on the liability side, they are slowly encroaching on what we do, and they are using either high-cost deposits, low-cost loans, technology, and really good phone service as a substitute for what we've historically done. So they are out there. So I think how we all respond to all of these factors is going to determine how we all succeed together in the future. And I know it's a lot of information. I know it's not great news. But I think the important thing and the most relevant thing about it is it's at a point in time. It's just not a lot of great news at a singular point in time. And we can debate what I think is not great news with what many in the room might think is arguable news. So, but I think if we can pragmatically take a step back from the operating environment and the economy and the dynamics of the consumer and kind of look at ourselves and our industry, we only have to answer three fundamental questions going forward. And the first is, what's our role in 2018 and beyond as community bankers? And then what are our growth expectations? And what are the growth expectations, not just of our shareholders, but of our communities and our stakeholders? And lastly, and kind of to wrap both those questions up, what's our highest and best use as community banks and community bankers? And this is a series of conclusions I've drawn, particularly over the course of the last 3 years. I really believe as an industry and individual institutions, and in talking to several of you today, we've all been shaped and hardened by the operating environment factors that I've already discussed. along with all of the outcomes from the downturn from 2008 into 2011. If you look at just using our capital level as a proxy for strength, I mean, we are clearly from capital in double-digit territory. Our profitability metric average as an industry is 114 ROA. Our return on equity is over 10%. So we are financially strong, we are profitable, and we are clean. Our capabilities are really deep compared to where they were as recently as 10 years ago. And I know, I view technology every day as being a threat outside, separate from anything to do with cyber. But on the other hand, it has been a tremendous equalizer for us to compete against the giants. And honest to God, I think for the most part, the entire industry, our houses are in order, both relative to 10 years. And all you need to do is look at exam data or just our own financial disclosures, our heightened financial disclosures. And I think you would probably agree with that. In 2018, we're more vulnerable as individual institutions to all of those operating elements I talked about and externalities as opposed to anything that's within our own walls. And it was the exact opposite 10 years ago. We had created our problems and the outside world was waiting for us, and now I think things have reversed. We are absolutely, as an industry, in community banking, more sophisticated by virtue of having gone through all of that adversity. So stress and shock testing, control environment discipline, all the investments that we've all made in compliance, audit, and risk tests, our risk monitoring, that all allows for earlier identification, for planning, and for remediation. I'm not saying this because of the setting. I also think all of our regulatory relationships, and maybe this is just me from my vantage point in Philadelphia, but my peer group in Philadelphia and New Jersey would suggest the same. All of our regulatory relationships are significantly better, and part of that is because there's much more communication between regulatory bodies than there was before. So exams foot nicely. Regulators talk to one another. Everybody's circumstances were known coming out of 2008 and 2011, so that's allowed for a lot of efficiency in communications. And our loan books are in good shape because our credit process is in good shape, and our underwriting criteria is really has held up nicely. Again, for me, I think we're pre-cycle relative to credit, but all of our non-performer antennas, they're efficient, pre-cycle, they're shallow and manageable, and so are our past dues, whether you're looking at individual institutions or you're looking at us as an industry. So that begs the most difficult question when you make a presentation like this is, so what next and what do you do, given that operating environment and the fact that we are strong individually and as an industry. And I think the answer for community banks goes back to a lot of the themes we've already heard today. I think we need to be the answer for someone, not something, more for people than for product. The spectrum of the papers that was submitted for this conference, small business, competition, management practices, and all the survey results, I think they all collectively point the way forward. And I think if you link them together, I think all of our futures as community banks are anchored in a different type of banking experience. We need to be in the conversation and education business for everyone. I have 5 areas of intense focus that I've been working on for the last 6 years with my team that I want to share. And by no means, in some cases we haven't started, in other cases we're either at the midpoint. The thing we started with was remodeling a lot of our branches so that we had libraries and that were based on stages of life and financial needs. So if you walk into, I remember we had a woman came down from the New York Times for an architectural review, and she said, I can't figure out if I'm in a post office or a library. And so my board was really upset, and I thought that was phenomenal because that's what I wanted. I think that's the direction we've wanted to take our buildings. But I think the main point of differentiation for us, for all of us, starts with each of our visions and missions. So at Beneficial, and you've all got stories that are similar, that we had a meeting in 1879. We found this in our minutes. It's been used as kind of a buzz phrase at the bank. It's a Latin phrase, visere comptis viris, which means simply always do what's right. So, and then our mission statement, which is newer, which is about 12, 13 years old, is educate customers to do the right thing financially. So you can hear those and they sound almost hallmarky, but things like that weren't cliches for the bank or for any bank in the middle of the last century. They were all givens. They were all the baseline of every customer's expectations. All of our buildings were places of trust, and we were respected. And I'm not so much nostalgic for all of that as I'm really trusting of that underlying formula. I think it builds really great institutions, it builds trust with employees and customers, and hopefully performance excellent. And coming from that, our second priority has been to take our mission and extend it as far out as we can into our brand. For me, culture inside our company and brand are a really powerful binary. The promise of our value is our brands and relationships and what we do with them, and I think that's even more so than the larger banks. I know it's going to sound a little bit counterintuitive, but I honest to God believe that we don't need to be the best at product. I think we need to be the best at brand and the best at culture, and that will lift service. And product, if it's a tie, or even if we fall a little bit behind, your culture will win because your people will win for you every time. In the 1940s, the 1950s, the 1960s, banks were places that were centered around these intense discussions with customers about their circumstances and their futures. So I don't think that we can be customer product providers much longer, and I don't even think we can be customer advocates much longer. I think if strategy is defined as the reconciliation between resources and the best possible outcome, then our new job as community bankers is to be customer strategists. I think we're built for that platform. That's the direction of our daily interaction with both retail and commercial customers anyway. I think it should be on all of our business cards. We're the answer for someone or some family or some business, not something or some widget that's being dispersed and sold by huge retail sales forces around the country. We should be about people, and we should not be so much about product. So in order to do that, at Beneficial, our large third priority is a huge primal focus on the employee experience. The desired outcome is just to have really loyal employees that are owners of the companies, which means all of our economics needs to be right, and you all know that in terms of base pay and in terms of either equity or phantom equity and in terms of whatever incentives are available. And all of that needs to be anchored in both fairness and results. But we've learned that our employee training now needs to extend way beyond traditional bank training. So we have life skills training, we have financial literacy training, conversation competency. We pay partially for college, we pay for professional certificates. We provide other services by reaching out to small businesses in our community. If you had told me, and this is the truth, if you had told me 5 years ago that I would be providing yoga and meditation 3 times a week in 5 locations, I would have been astounded. But if you had told me on top of that 70% of our employees access that at least once a week, I'm shocked. There's a demand there for that. And those small business providers that come in and provide that, that's fueled their small businesses because they're taking those people out of the bank into their studios for those types of activities, not during bank time. So the biggest thing that I think we all need to focus on is making sure our employees understand that we're local. It's our largest differentiator, and I'll get to that in a minute when I talk about small business. All of our hiring tactics, they just need to mirror the types of personalities that we want evidence in our business tactics. I think my main goal is to make sure that all of my employees are comfortable enough within a range, within the confines of their careers, to be really comfortable enough to sit down and have an intelligent conversation with their customer counterpart using an iPad or a whiteboard or chalk on the sidewalk, just something that they can have a dialogue with the customer and start that and feel really comfortable about that conversation. The customer experience is already segmented. We're not different than anybody else, so there are now transactions on the one side and what we view as being customer planning on the other side. So I really believe that the primacy going forward is a real plan for every customer and for every one of the products they hold. As I mentioned, I think we need to be customer strategists and we need to be context providers. We're a mass market industry competing in a completely curated world. Amazon knows everything I want, everything, and Keurig knows everything I need. So right to the exact formula and the right cup size. And that's what we're all facing, not just with millennials, but I think that's our obligation to our customer base. I honestly believe that every one of your customers needs to have a page, a home page inside your bank. It needs to be almost like a two-way mirror, and it doesn't need to be perfect. So all it needs to do is list a couple financial goals and some objectives, maybe some modeling tools. It doesn't need to be rocket science, and they need to be able to let you see it, and it even needs to permit if they want to put other providers in. So, and if Fiserv can't build it for you, or Jack Henry can't build it for you, or if FIS can't build that for you, go to Eastern Kentucky University, because they most certainly, they will, and they will cable it right into your core, I guarantee you. So I think that's the next experiential thing for customers. I think they want to be tied to a community bank, but they need the next level of technology, and they need to have a plan. This millennial generation wants a plan. I mean, they're planners. They've been carrying phones around since they were infants. They're used to that. They're used to prompts. They're used to cues, and I think it's our obligation as an industry to provide it. And that's what the larger banks are doing. That's all around, the AI and everything that they're developing. We will shortly be competing against all of that. And that's as true on the commercial side as it is on the retail side. We have a very defined discipline about once a year we go out. And I do make house calls. So if it's $1 million loan or more in our bank, and we've got a lot of $1 million loans and more, somebody from our bank goes out and sits and doesn't just go through the financial statements. We go through their strategic plans if they will let us. And we ask them if we can document it, and we put it in the credit file. So we try to make ourselves not just part of their financial life, but we really want to understand their business. So phones, iPads, laptops, they're all just synthetic buildings for us now, I think. I think our best buildings should be saved for, and I mean that, our best buildings, because I think we're going to start losing a lot of our real estate. Our best buildings should be centers that first and foremost support financial education, financial conversations with informed employees, and then secondarily, they should be able to do transactions. There should be real conversations happening there about goals. I had a whole section on small business, but I'm going to summarize it by take out the papers. I really believe that they're pointing the way forward. There are 28 million small businesses in this country that can instantly reshape our balance sheets if we engage with them more rapidly than the fintech tidal wave that is coming right at them. So half the people that wake up in this country in the morning go to work for a small business. They are also consumers who need consumer banking, retail banking, and mortgages. So we had, prior to announcing that we were being acquired, we had put together a task force, and we're ready to roll out a massive, and I think the new bank will do this also, kind of reintroduction of our small business capabilities. So the one advantage that we have besides being local and besides speed is you are going to have, this is an old-fashioned word, kinship based on locality with the small businesses in your market. You have more of an emotional tie, and so do your people. 78% of our people grew up within, I think it's a 15-mile radius of our headquarters, who work for my company. The point was made earlier, we go to the same churches, we go to the same libraries. We can't point to another city and say they didn't get their loan because of a decision that was made out of market. So that locality and that emotional bind to a local small business is extraordinarily strong. And from a business standpoint, even if you're just a mercenary, you can capitalize on that to get market share. So with that, we all need growth. I understand that. I just think that, trying to bring this to a close, the basis of that growth is doing more with the customers that we have while we're trying to take market share. Try to get more employees and customers, rely on them to get us more employees and customers as well. And I do think that we're all about to be tested. I think we're already being tested. I feel like we've been tested since 2008, but I think it is, at the end of the day, all about leadership. It's all about understanding leadership. We're in a rapidly transitioning and consolidating industry, and the way forward is there, but I believe it's challenging. I think financial responsibility and accountability are the hallmarks of community banking. They're our ethos, they're our legacy. That legacy needs to be revisited for its most virtuous elements. And I think just looking backward for even just for a few moments, the way we used to do things, I think that's a really positive step forward for the future. Thank you all very much.